corporate governance, concept, principle. Hello everyone. I am ANDI WAHYUDI. Today I will discuss the material and enjoy watching corporate governance, concepts, principles, frameworks, and global practices. 1. Introduction to Corporate Governance 1.1. Definition: corporate governance refers to the system by which companies are directed and controlled. It involves a set of relationships between a company's management, its board, shareholders, and other stakeholders. It provides the structure through which the objectives of the company are set, and the means of attaining those objectives and monitoring performance are determined. According to the OECD 1.2 Evolution and Historical Context, corporate governance has evolved significantly, especially in response to corporate scandals and financial crises. 1. 1992, Cadbury Report, UK, established the foundation for modern corporate governance. 2. 1999, OECD Principles of Corporate Governance became a global benchmark. 3. 2001, Enron and WorldCom scandals, US, led to the Sarbanes-Oxley Act, SOX, in 2002. 4. 2008, global financial crisis, exposed serious governance failures in financial institutions. 5. Emerging markets, for example, Indonesia, post-1998 reforms emphasized transparency, accountability, and stakeholder engagement. 2. Objectives and importance of corporate governance. Corporate governance serves both economic and ethical purposes. 1. To ensure accountability and transparency in business operations. 2. To protect shareholders' and stakeholders' interests. 3. To support sustainable business practices and long-term value creation. 4. To minimize risk and prevent fraud. 5. To enhance investor confidence and market stability. 3. Key principles of good corporate governance, GCG. Most governance frameworks are built on 5 universally accepted principles. 3.1. Transparency. 1. Accurate, timely, and accessible disclosure of financial and non-financial information. 2. Enables stakeholders to make informed decisions. 3.2. Accountability. 1. Clear roles and responsibilities for board members and management. 2. Mechanisms for evaluating performance and enforcing consequences. 3.3. Responsibility. 1. Legal and ethical compliance in all corporate activities. 2. Commitment to social and environmental obligations. 3.4. Independence. 1. Decision-making free from undue influence or conflicts of interest. 2. Presence of independent directors on the board. 3.5. Fairness. 1. Equal treatment of all shareholders, including minority and foreign investors. 2. Consideration of stakeholders' rights and concerns. 4. Corporate governance structure. Corporate governance operates through a multi-tiered framework. 4.1. Shareholders, General Meeting, AGM. 1. The highest decision-making body. 2. Approves major actions such as director appointments, dividends, and financial statements. 4.2. Board of Commissioners, non-executive directors. 1. Supervises and advises the executive directors. 2. Establishes governance committees, for example, Audit Committee, Risk Committee. 4.3. Board of Directors, Executive Management. 1. Responsible for strategy implementation, daily operations, and performance. 2. Reports to the board and shareholders. 4.4. Audit Committee. 1. Oversees financial reporting and internal controls. 2. Ensures auditor independence and compliance with accounting standards. 4.5. Corporate Secretary and Compliance Unit. 1. Ensures adherence to regulatory requirements. 2. Facilitates communication with regulators and shareholders. 5. Regulatory framework and governance codes. Corporate governance is governed by a combination of laws, regulations, and codes. 5.1. International standards. 1. OECD Principles of Corporate Governance. 2. IFC Corporate Governance Framework. 3. ISO 37000, Governance of Organizations. 5.2. Examples from Indonesia. 1. Company Law, Law Number 42007. 2. Financial Services Authority, OJK, Regulations. 3. Indonesia Stock Exchange, IDX, Listing Rules. 4. National Committee on Governance Policy, KNKG, Guidelines. 6. Corporate Governance Models. 6.1. Anglo-American Model. 1. Emphasizes shareholder primacy and market mechanisms. 2. Strong role of institutional investors and independent boards. 6.2. Continental European Model. 1. Stakeholder-oriented approach. 2. Two-tier board system, management board and supervisory board. 6.3. Asian Model. 1. Often characterized by family ownership and state involvement. 2. Reforms focus on increasing transparency and curbing nepotism. 7. Stakeholders in corporate governance. Stakeholder theory suggests that governance should not only benefit shareholders but also 1. Employees, fair wages, safety, career development. 2. Customers, product quality, consumer protection. 3. Suppliers, fair contract terms and ethical sourcing. 4. Communities, environmental protection and social contribution. 5. Regulators and governments, compliance and tax transparency. 8. Corporate social responsibility, CSR, and ESG integration. 8.1. Corporate social responsibility, CSR. 1. Voluntary initiatives addressing social and environmental concerns. 2. Often integrated into governance and sustainability reports. 8.2. Environmental, social, and governance, ESG. 1. A set of standards used by investors to evaluate corporate behavior. 2. ESG is increasingly aligned with long-term shareholder value. 9. Benefits of strong corporate governance. 1. Improved access to capital and lower cost of financing. 2. Greater resilience during crises. 3. Enhanced reputation and brand equity. 4. Reduced fraud and misconduct. 5. Increased operational efficiency and innovation. 6. Better stakeholder relations and employee morale. 10. Common challenges in governance implementation. 1. Lack of board independence. 2. Dominance by controlling shareholders or founders. 3. Weak internal controls and risk management. 4. Ineffective audit committees. 5. Corruption and lack of legal enforcement. 6. Resistance to transparency and accountability. 11. Technology and digital governance. Modern technology transforms how governance is practiced. 1. Blockchain, immutable records for financial transactions and smart contracts. 2. Big data and AI, detect patterns of fraud and misconduct. 3. Digital disclosures, enhance transparency for investors. 4. Whistleblowing platforms, safe reporting mechanisms for ethical breaches. 12. Global implications and trends. 12.1. Globalization and cross-border governance. 1. Multinational companies must comply with multiple governance standards. 2. Regulatory arbitrage and harmonization are key issues. 12.2. ESG and sustainable investing. 1. Investors demand environmental and ethical governance practices. 2. Climate risk and human rights are central